Well, the Dow holding around 40,000 after closing at the landmark level for the first time ever on Friday. And that has Wall Street feeling pretty giddy. But Main Street isn't necessarily feeling all the love. Consumer sentiment is at a 6-month low, with Americans citing inflation, high interest rates, and concerns over unemployment. This is backed by a recent Gallup poll where 41% of Americans name inflation, or the high cost of living, as the most important financial problem facing their family. And in the corporate earnings world, 219 S&P 500 companies mentioned the term inflation on Q1 earnings calls. That is still staying above the 10-year average, but quarter over quarter at least showing some easing. So what is this discrepancy between stocks at all-time highs and consumers feeling down on the economy? Joining me now, we've got Eric Freedman, who is the U.S. Bank Asset Management Group Chief Investment Officer. We've also got Stephen Ricchiuto, who is the Mizuho Securities U.S. Chief Economist of Fixed Income. Great to have both of you here with us today. Let's start first on the economic side of this. And Steve, particularly as we think about where there is this disconnect between what Wall Street's saying and what Main Street or what the household economics are feeling right now. What's jumping out to you the most, at least in the sentiment readings that we're seeing?
Well, I think the difference really is the price level is the problem for households, not necessarily the inflation rate. It's the level of prices. Prices went up substantially in the post-COVID environment, and they continue to be at a high inflated level. And that has really eaten into household disposable income in terms of their discretionary spending. Now, on the other side of this equation, the inflation is helping corporate America produce solid earnings, and as a result, it's driving the equity market. So the tale of two, I don't think really is necessarily the tale of two. It's the same thesis going throughout in here, that prices are high, inflation is helping to keep those prices remaining high, and that's really driving the ability of companies to have pricing power, and that's driving earnings, and that's what's driving the equity markets.
And so, Eric, how much is that showing up in earnings, as Steve was just mentioning?
Yeah, it's showing up quite a bit. If you look at the overall levels of corporate earnings growth expected for this year at about 8.5%, and then next year expected at 10.5%, those are some pretty large numbers. And certainly part of that is just inflation. If you look at what we're seeing in nominal terms or non-inflation adjusted, you're getting that higher for longer type of mentality really seeking into and seeping into corporate earnings. So I think the other thing that's really important is not only is it impacting corporate earnings, but also the housing market. And one of the things that you're seeing is that if you own a house, your house value has probably gone up. You're spending more money. If you don't own a house, you want one. It's, of course, very difficult to get one, both with respect to housing prices, but then also the cost of financing. So that has a double-edged sword effect, if you will. If you have a house, you feel pretty good about it. If you don't, you're really in a tough spot because of just how unaffordable housing has been and likely will be for some time.
And just to follow up on that as well, I mean, that is one of the areas that the Fed and data continues to point out, is that when you have homeowners equivalent rent, or when you have the cost of shelter and the cost of energy continuing to be the stickiest parts of inflation, there is a consideration for where that also impacts other areas of household spending too. And Eric, just to follow up on that, has that shown up in, especially as we're looking for some of these retail earnings over the course of this week, where CEOs are talking about pullbacks in certain aisles because there are elevated expenses that households have to consider right now?
Yeah, Brad, we are seeing that. And if you look at some of the overall, let's call it demographic differences, you've got middle income and upper income consumers doing pretty well. Lower end consumers are actually, I should say, lower income consumers, those that are really having a tough time with borrowing costs. This elevated also oil prices, which remain quite sticky. That's a larger part of their consumption basket. So that has been an environment that has been relatively persistent. Starting to see that really pick up, though. And if you look at some of the earnings we had last week, as well as from retailers this week, those are really important tells for us to understand just what sort of dichotomy we're seeing across the consumer landscape. So in general, consumers are doing well, but you're starting to see some level of disparities across the different income cohorts, which again, corporate earnings can provide some more insights into.
Steve, just one more question on the economy here, and then I want to shift to some investing strategy. But specifically, as we think about what will force the Fed to cut, what is it that's going to show up in the data that will finally perhaps be the determining factor outside of us getting to that 2% target that seems ever elusive, at least as of right now?
Well, let me be clear. We don't have any rate cuts priced into our forecast for 2024. And the reason for it is we don't think the economy is going to give them the opportunity. What could give them the opportunity would be a deterioration in the labor market. And it would have to be a bit more of a sustained deterioration in the labor market, given the fact that inflation has gotten stuck. So I think the reality is there's likely to be less, if not no, rate cuts this year. And that is the one thing that I think is missing from the valuations in the equity market as we continue to grind higher here is, yes, earnings are very, very good, but the market also is assuming that you're going to get rate cuts this year, and that may continue to get pushed further out in the calendar. Now, does that suggest a correction in the equity market? Probably not. But I think you have to think about 2024 more as a year in which the economy catches up to the equity market rather than the equity market, retraces back to the economy.
Eric, as we're thinking about the equity market here, Dow crossing 40K, significant milestone for investors that are trying to figure out, okay, what next? They're charting their own strategy, even from a high like this. What is that next natural consideration as investors have to realize or think about the trends that have driven us to this point and whether that's still locked in so much so that they can remain comfortable in what are becoming some very overcrowded trades?
Yeah, I think that really is an important focal point in terms of the notion of overcrowding. Look, Steve and his team do outstanding work, and we have similar conclusions about just the importance of interest rates when we're looking at things like discounted cash flow models, the way that we try to look at stocks or bonds or other instruments. And so the key consideration is where will we actually see interest rates settle out over time. And there's been a little more of a reconciliation between the Fed and the market in 2024, but 2025 and 2026, there's a bit of a disparity there. And one of the reasons why we think there's a disparity is because we think that the market expects commodity inflation to actually hang around and potentially even inflate from here. So one of the things that we're doing in portfolios is actually hedging with physical commodities. We think that's a good thing to own in a client's portfolio. You generally don't have that same type of exposure in corporate earnings. And so owning more index-based commodity exposure, we think makes some sense. The other thing that we're doing is really diversifying sources of cash flow. For people who just own stocks and bonds, we think there's lots more that you can do in a client's portfolio. And so owning things like reinsurance, owning things like non-agency mortgages, those are, we think, some unique and interesting sources of cash flow because, again, this notion of rate cuts or no rate cuts, but also probably more importantly, where will the Fed settle out over time? Will we get back to that lower federal funds rate that we enjoyed post the 08-09 crisis? We don't think so. We think it's going to probably normalize somewhere with a 3 in front of it as opposed to the 5 in front of it right now. So I think there will probably be some level of rate cuts, but not as many as the market may anticipate for this year and perhaps the balance of next year.
And so with that in mind, for a normalization portfolio strategy, are there areas of the market that investors can feel comfortable with a set it and forget it strategy, and which sectors would that be in, Eric?
Yeah, probably never a set it and forget it, just because it is this is one of those environments where things are moving around quite a bit. But I'll tell you some of the areas that we're pretty focused on. Number one would be the energy market. Again, we talked about commodities a second ago, but energy companies have been very disciplined. They've been forced to be so through shareholder activism. So that's a spot that we think there's still an opportunity to unlock some value. We still like technology, although we do think that there's, again, a big stand and deliver time this week. If you look at what you're seeing in AI, the notion of more, let's call it OEMs or producers actually delivering services across the landscape will be important to justify evaluations. I also think there's an area that is probably a little less appreciated is equal weighted S&P. You talked about the Dow reaching its all-time high. Equal weighted S&P has lagged for the last couple of years, and for good reason, because of course we've had more of a tech-driven backdrop. So we think that for those clients that are looking for a little more safety and also want to participate in large cap companies, because we actually think there's some refinancing risk in small cap, owning equal weighted S&P is probably our preferred method of getting large cap equity exposure right now. those would be the things that we're more interested in this environment, Brad.
Just lastly, while we've got you guys, Steve, we heard Yardeni Research essentially say today the Q1 2024 season is over. Earnings season is over, they said. And, kind of looking at the S&P 500 EPS as the basis there versus the actual results that it came in and it exceeding expectations. All of those things considered from a macroeconomic perspective, as we look out to the rest of the earnings seasons that are set to come over the course of this year, what is one major theme that investors should be prepared for coming up from the purview of many C-suites?
Yeah, I think as long as the Fed is telling you they want to cut rates, even though they're not necessarily ready to pull the trigger, the buy on dip strategy really just continues to dominate in the marketplace. And I think that's going to create an opportunity for people to originate not only debt, but also a new equity origination going forward in here. The spreads are very, very tight. Yields are about 20 to 30 basis points lower than we were at our recent peak. And I think you're going to get people looking to come in and tap the market as a result of that.
My thanks here to U.S. Bank Asset Management Group CIO Eric Freedman and Mizuho Securities U.S. Chief Economist of Fixed Income Stephen Ricchiuto. Gentlemen, thanks so much for taking the time here this morning.
Great to be here. Take care.
Thank you. You too.